not share the answers. Is that okay? And by the way, you've already got the answers. So just to make sure, I'll be checking the formulas. I'll be going through each of the answers and double checking the right formula, and that's it. You should be done.
So are we gonna have a final next week, or is it just gonna be?
If we go for that format, I think we don't have to have that in the class, because those who have not, done it in Excel, it will take a lot of time. It will take a lot of time. And
So you just give us a list for.
But you're going to tell us exactly why, right?
Like.
so I can give you just this is an assignment.
Right. Yeah.
Good.
Makes sense to me, because I mean, even later on, if I have to do this stuff, I can't necessarily remember every formula,
Mm-hmm.
but I can, use Excel or
Exactly.
look it up. Like, that's right, that's how you do that.
Exactly. Yeah. And I think that's going to help you a lot in particular.
Well, I learned a lot just using Excel.
Good.
There's no where to look something up, it just works. Remembering.
And the purpose of the course was to understand why do we do this. So we discussed it. We now understand the concept. You're not supposed to remember the formulas. They're always there. But if you understand how to use the formula, those are the tools. And you should be able to use the tools according to your needs. And that's, I think, the purpose.
I do have a question.
Yeah, sure.
Does every single question have an Excel formula? Because I didn't start doing the Excel stuff for like the past couple assignments. So like the ones in the beginning, so does every single question work out as an Excel formula?
Well, yeah, pretty much everything has an Excel formula, or you can build your own formula in Excel as well. Okay? And, I will also try to refine the videos, get them, and share the videos with you. So if there's any confusion, you can go to the videos and watch them and learn how to use it. There are also a lot of videos on Excel. So if you have to calculate, for example, NPV, you can search that on the internet, and there will be a lot of Excel help available. So you can do that as well.
All right, perfect. Thank you.
You're welcome.
Good.
Yeah, we're good. Yeah, thank you.
All right. So who completed the Excel template that I gave you at the end of the class last week?
The other ones that you said that
Yeah. You did. Anyone else who completed the?
all but the
So sorry.
Oh, all of it but the last one.
But the last. Okay.
Also, on the Mac, I couldn't figure out how to do the graph. On the regular laptops, it's pretty simple, but I can't figure it out.
Well, I think, I'm not I have never used that. So probably you'll have to search the internet to find help on this. So I cannot help with that, because I have not used it. But it should be, so the functions are going to be pretty much similar. There will be some, maybe the buttons are somewhere else.
I couldn't find it. I looked, but I tried.
Yeah, well, I can have a look during the break. I do look. Honestly, I don't know.
Yeah, I put it side by side with each showed the functions on how this would work for whatever reason.
All
Mine failed.
right. Okay.
No, the other guy figured out what this.
Ali?
For the Mac.
No, it wasn't. Remember we were in here and he found like the chart thing
Right.
somewhere on there. The chart on it. But it was the same chart.
Yeah, thank you. Yes.
All right. So I think we need to go to that Excel file first. Was it this one?
Yes. Yeah.
Okay.
Can you make that a little bit bigger, please?
Yeah,
Okay.
sure.
Sorry.
Good now?
Yeah.
Okay. So where were you stuck?
Right there.
Okay, big.
Yes.
Okay.
That one.
Yeah.
All right.
Cumulative.
All right. I can do that for you. Anything else?
Just the bottom end.
Okay. So let me go through this, and rather we'll go through this together. You have done this, right? So you need to help me, or can I request you to come over and do it you?
Yeah, I think that's it.
Okay.
Let me take mine.
Yeah,
Remember,
you can get help on that.
so, so we have to discount, first you have to discount each one of the cash flows. So I used the formula for that, or, the formula, so this equals,
I think the discounted is the next one.
oh, this one's not the discounted?
Do you have a problem only with the discounted or
Hold on.
only the discount? So the next one.
Oh, okay, I'm just in the wrong group.
Yeah.
This one. Yes.
Yeah, exactly.
Okay, so the discounted, that's so equals percent divided by 1 plus 3.
That's what we did last week, right?
Did you have to do it in class? Did you do it in class or did you take it?
We started. I'm pretty sure that's which
Which person are you talking about?
At the interest rate, T1 plus whatever the interest rate was.
Okay. And that's where? WACC.
Once divided by.
It's the future value divided by 1 plus the interest rate, and you want to lock that and to the power of the year. So that's your future value, the D105. So it's your future value divided by, oh, I'm sorry, that's why you're not seeing that. 1 plus the rate to the power of the year that it is. So then you want to lock the interest rate. So then,
I was maybe okay, but
I don't think he knows you want to get in.
no, I keep talking, I thought everything, and it was okay. But yeah, like I don't know, like there's so much love when I'm in the house. Like my son got sick, and my husband got sick, and then I got sick.
The last one just to.
To do all the something, but in it.
What?
Like, you know how the homework assignments do some of them like longhand, or you can do like one hard Excel, but that's the final. Do all the
drag to the next one, it'll change your future value. So then the present value will be equal to the future value divided by 1 plus the interest rate to the power of whatever year you're in. Then once you have the discounted cash flow, then you need to the cumulative cash flow for each one of those. So in the first year,
We don't do that, then. Zero or
so that's going to,
And that's just like an assignment.
and then you're adding the rest of these. So the next one, you just do equals this plus this. And then from there, you can drag the rest of that across.
unfortunately, he might go there. Go there. See, we get started on it.
Yeah. Maybe that's the answer to everything.
So you're just adding your discounted cash flows to get the cumulative. So when you drag it across, all you're doing is adding this number to this number, and then you're adding this number to this number, and on down. So then the discounted payback. Okay, so that one is, it's the year. You have to find where you're going to hit 0. So then that's equal to, yeah, so that's equal to the year prior to when you hit 0, plus, and I do a plus minus because you have a negative number, so I do a plus, a negative, and then the cumulative discounted cash flow at that time, and that is divided by the discounted cash flow of the next year. All right. Divided by.
I did our homework.
Then you come up with the 5.2 years for your payback period. And then you can take 12 times 0.32 to figure out how many months.
Every
Right.
So we'll go back and just figure out. We got the answers.
Yes.
So how to get the answer to the formula.
You can do that for the next one. So is everyone clear on this now?
No, I-
Okay. All done? Okay, so if you want me, I can go through the remaining, the rest of the initial ones as well. But I think that's pretty easy, right? There's no big deal in these calculations. IRR, that is still to be discussed, so we'll do that. And the rest is all done. Okay. Now let's go to the next topic. We started this chapter last week, and we could not finish. So what are we discussing in this chapter? We're talking about capital budgeting techniques. And those techniques are used to evaluate potential projects. We will accept the projects that add value to the company and reject those that either don't add value or add a negative value. And there are a number of techniques that we use for this purpose. One of the techniques is NPV, the net present value. We discussed that in great detail last week. We also discussed the payback period, which is another technique. And then two other techniques that we normally use are the IRR, which is the internal rate of return, and the profitability index. Now, profitability index is very easy, no big deal, but we need to do a little bit of calculations to understand the internal rate of return. And how do we use this technique for capital budgeting? How do we use this for evaluating potential projects? All right. So let's start this one. Okay, so the first one that we discussed was NPV, and you were very clear on this one. We also discussed the payback period, and here we calculate the number of years it takes for us to recover our initial investment. We also discussed a modified version of this one, the discounted payback period, which actually considers the time value of money into account. This one, the payback period, does not. It only considers the accounting numbers. But here, we take the time value of money into consideration, and we just did a problem on that as well. The third one, a technique that we're going to use is what we call the IRR. And this is abbreviation for internal rate of return. Internal rate of return. Now you understand what rate of return means, right? What is rate of return? It is the percentage rate that we apply to discount the future value or to compound the present values to take them to the future. Now, what that rate of return might be, it may be our required rate of return. So that is what we require, the least, the minimum that we require in order for us to invest in a particular project. Make sense? Now, this rate of return could be the rate that we're paying to lenders of the funds, who lend us the money, or, So this can take different forms. Here what we consider is the rate of return that we are seeking from our investments. The rate of return that we seek from our investments. Now what we do is that if we have the rate of return, and let's call that rate of return as R, and that is, for example, 10%. So 10% is our required rate of return. Now, if we find a project that pays us at least 10%, we would accept the project. If not, we would reject the project. Now, why is this our required rate of return? We discussed this last week. There may be different reasons for that. Either this is the rate that we have to pay to our lenders, and that is the minimum that we require, or it may be a bit more than that. For example, we pay 8% to the lenders, but we add at least 2% for the project to be viable. So if a project can pay us 10%, that covers our borrowing costs, plus it also covers something. It gives us some benefit. So this may be our required rate of return. It also depends on the risk profile of the investor. So if you are a type of businessman who tries to avoid risk, then your rate of return for a slight risk may be higher than those who have a good risk appetite. So there are a lot of factors that we consider. Now let's just assume that we understand that this is the required rate of return. And why do we require 10%? We have already done our calculations, and we need a minimum of 10% rate of return. Now let's consider a scenario. Somebody is offering you an investment project, and that is something like this. You are expected to invest your money at time 0, and the project will come to an end at the end of the first year. Okay? How much are you going to invest? For example, the total investment is $180 million, and your future cash flow, the future value, is going to be, suppose, $198 million. Are you going to accept this project? You can apply the techniques that we have learned so far. And what are the techniques that we have learned? We are not considering the payback here. This is just, forget about that. We have learned NPV. You can apply the NPV technique and decide whether to accept the project or reject it. Can you do that for me? Can you find the NPV of this project? So let me write that one clear. This is the project, 1 year investment. We start at time 0 and we finish at time 1. $180 million is investment, so you can write that as a negative cash flow. And $198 million is the inflow at the end of 1 year. You know that NPV is equal to present value of future cash flows, okay, minus the initial cost. And the cost is already in present. Or you can simply write that down, the sum of the sum of the discounted cash flows. All discounted cash flows. So you can use this one. The present value of the future cash flow. This is the future cash flow. You can find its present value. So present value of future cash flow is equal to the future value divided by 1 plus the discount rate that we're going to apply raised to the power n. And future value in this case is 198 divided by 1 plus 10% raised to the power 1, because the number of years 1. Simply divide 198 by 1.1. 198 divided by 1.1. That will give you the present value of the future cash flow. $180. So this is equal to 180, exact? So what are you going to do? Are you going to accept this project or not?
Most likely.
So the present value of future cash flows is 180, and our investment or cost is also 180. So who says we are not going to accept this project? Steve? Okay, 1, 2, 3. Is there anyone who would like to accept it?
If this is the only option, then yes.
Okay, and Kevin?
It's not a negative. It's not a four.
Okay.
We can just accept it so we can make it pay back. But yeah, that's it.
Okay. Yeah, I think it depends. I mean, like what you mentioned is that if there's no other option, if there's a better option, we can go for that. But is Kevin also mentioned is that it's not negative. It is a 0. And what does that 0 actually mean to us? We are considering this 10%, which we use as the discount rate. We call this is our required rate. So when the NPV at 10% is 0, that means the project is meeting our minimum requirement. It is meeting our minimum requirement. Now, why do we call this our minimum requirement? Maybe 8% of this is the borrowing cost, plus we have added 2% for our profit or a value addition. So actually this 10% is meeting our minimum requirement. Or this may be a minimum requirement for whatever reason. So yes, I think that is a good option to accept this. But of course, if you have a better project that can give you more, you will accept that one. Now let's modify this example a little bit. Let's say that the future value is 100, or let's suppose 205. What is the NPV of this project going to be? In this case, the NPV is 0. 186. So NPV in this case is equal to $6 or $6 million. NPV in this case is $6 million. Now, what does this tell us? Are we going to accept the project? Yes, because it has a positive NPV. Again, if there is a better project that has a higher NPV, we'll go for that. But if this is the only option, we will go for this one. It has a positive NPV, and this is going to add value of $6 million to the wealth of the shareholders, as we discussed in the previous class. Now, if I ask you this question, is this project meeting our minimum requirement?
No.
Okay. We don't know. Yes, it does. Who says it meets our minimum requirement? Yeah, Halid says yes. Yeah, Kevin, you agree with that? It is stated. Because our minimum requirement is 10%, and it is giving us $6 million in addition to the 10%. Does that make sense? So, in other words, we can say that this project is exceeding our minimum requirements. Okay, and we should be very happy to invest in this project. Okay, now, can I ask you this question, or required rate of return is this one? Can we say in this case that the rate of return that the project actually gives me is more than 10%?
Yes.
Yeah. Because if it is only 10%, it should give me an NPV of 0. But it is giving me a positive NPV. That means that the project's own rate of return is more than my required rate of return. And that rate of return of the project itself is what we call the internal rate of return, because it is internal to the project. Sounds good? Okay. That is the whole concept of the internal rate of return. Sometimes people find it difficult to understand, but I think I made it quite clear to you. So that is the internal rate of return of the project. Now, let's write that down again. This is the project, 0 and 1. We're making an investment of 180, and we are receiving a 205. And when we calculate the NPV of the project, we get $6 million. Now, what we understand is that this project's internal rate of return, let's call that IRR. This IRR of the project is greater than our required rate. That is what we know for sure now. But what is it exactly? Do we know that? It is good. It may be 11%. It may be 10.1%. We don't know yet. So if you calculate that rate, that is the IRR. It's that simple. Easy? And we can do that. You have already learned the techniques to do this. Let's use our formula. So what do we do in NPV? Well, we say that NPV is equal to the present value of future cash flows minus the cost. This should be equal to 0, is per the definition. You can put the formula. The future value of the present value of future cash flow in this case is future value divided by 1 plus our rate, but we're not going to use the R because that is our required rate. What we're trying to do is to find the rate that the project itself offers. Let's call this some other name. Can we call this IRR? Yeah. So let's call this IRR instead of our required rate. Raised to the power n, and this should be equal to the cost, which is the present value. Okay? You can put the values in this formula. So 205 divided by 1 plus 10% raised to the power 1 equals to 180. No, not 10%. We are going to use the IRR. This is the unknown variable we need to find. Okay, so we can modify this, rearrange this formula. That is going to be 180 multiplied by 1 plus IRR raised to the power 1. So that doesn't mean anything, raised to the power 1, but you can write it down. Equals to 205. Does that make sense? Or you can write this down as 180 plus 180 IRR, this is multiplication, equals to 205. No, not like that, but anyway. You can skip this one. You can write 1 plus IRR equals to 205 divided by 180. And IRR is equal to 205 divided by 180 minus 1. Can you do this for me? The 1 goes to the other side of the equation, so that becomes minus 1.
13.88%.
What is it?
13.88%.
13.88%. So now we know the internal rate of return. Previously, when we calculated the NPV of the project, we came to know that the NPV was $6 million, and that tells us that the internal rate of return of the project is more than what we require. But what is that internal rate of return? Now we know that. That is 13.8%. It is way beyond our expectations, and the project is very good. Is that clear? So now this was a simple problem. What if we make this investment for 2 years? It will make things a little complicated. Okay? So if you make the investment for 2 years, so it will be something like this. Let's consider 0, 1, and 2. So you are making an investment of present value, okay? And you will be receiving the future value after 2 years. Future value. This is now going to be equal to the present value is going to be equal to future value divided by 1 plus IRR, because we don't know that, raised to the power n. And that will be 2 in this case. So you can put these values in this formula, what we got here. So the only thing that changes, I think, is this power 2, right? So let's go there. This will be 180, 1 plus IRR raised to the power 2 equals to 205. Or 1 plus IRR whole square is equal to 205 divided by 180. Okay, now you have to expand this formula. If you know a little bit of arithmetics, are you familiar with this formula, A plus B whole square? This is algebra. This can become A square plus B square plus 2AB, if you remember.
What is
Yeah, we can do that, but I have something to tell you here. I want to go that way. There's a logic on that. Well, you can do that, the square root, of course. Okay, so here we can expand this one as well. So this will become 1 squared will be 1 plus IERR square plus 2 IERR equals to, what is this?
1.1.
1.138. In other words, if you look at this equation, this is what we call the quadratic equation, isn't it? So you can rearrange this ax squared plus bx plus c equals to 0. So you can bring that to this side of the equation, and this will become 1 IERR squared plus 2 IERR, and that will become minus 0.138 equals to 0. So here you go. Ax squared, if IERR is the x, plus bx, minus 0.138. So this is a quadratic equation. Is this a bit too much of mathematics? Okay, by the way, you don't need to remember this, but you need to understand the logic. And it will be just a refresher. So now, when you have this formula, ax squared plus bx plus c equals to 0, this is what we call the quadratic equation. And if you solve this equation, these a, b, and c, these are constants. You can solve this equation for x. So the value of x is going to be plus minus something. Let's say plus minus 12. So this x can have two values that will satisfy this formula. If you put either plus 12, by the way, it's not going to, it's just a hypothetical. If you put plus 12 instead of x in this formula, it will make it 0. But if you put minus 12, it will still make it 0. So there are two values that can satisfy this equation, that can complete the equation. Now, why do I need to tell you this? The point is that we were using this x for IERR, right? Now, the IERR, because the IERR equation has now become a quadratic equation, the IERR can have two values now. IERR can have two values. So let's say this is the IERR in plus minus 12. Now, this makes the situation more complicated. You cannot have a positive return of a project and a negative return of a project at the same time, even though the mathematical solution gives you this. Now that is one of the shortcomings of IERRs, and then we will have to go to use the modified IERR to address this problem. But before going to that, let's do a few examples of this. So let me take you to the slides. Okay. Internal rate of return. So what is the internal rate of return? The discount rate that sets NPV to 0. Discount rate that sets NPV to 0. And that's what we did. We put the values in the NPV formula equals to 0, and we tried to find what rate would satisfy that formula. And the minimum acceptance criteria is if the internal rate of return, if IERR is greater than our required rate, what are we going to do? we will accept it because it exceeds our expectations. If IRR is less than R, it does not meet our requirements, our minimum requirements, so we are going to reject it. But if this is equal to R, the project is meeting our minimum requirements and we want to invest in the project. Okay? Now, this criteria of IRR is quite similar to the NPV criteria because you can correspond to this. If we don't have the complications, for example, the multiple IRRs, like we discussed the example, we had plus 12 and minus 12 when it goes to 2 years. And if it goes to 3 years, there will be Q power, third power, and there will be many more values possible. So the IRR can have 2 values, it can have 3, 4 multiple values. So it will become much more complicated. But if we have a situation where we have just one IRR, then this IRR rule will be quite similar to the NPV. Because in this case, if IRR is greater than our required rate, then NPV in this case is going to be greater than 0. Does that make sense? Mm-hmm. And when this is less than IRR, then NPV will be less than 0. And if IRR is equal to R, then NPV will be equal to 0. So you can simply either use the NPV technique or the IRR technique. Both of them will give you the same result. But if there are multiple IRRs, then you better rely on NPV if you don't understand how to address those issues in IRR. However, IRR may have its own benefits as well. Let's go through that one by one. Ranking criteria, for example, if you have 3 or 4 different projects, so you will accept the project that has the highest IRR, as we do in case of NPV. You accept the project that has the highest NPV. And then reinvestment assumption. Now this is the IRR formula actually assumes something. And that assumption is what we call the reinvestment assumption. What does that mean? Suppose that you found the IRR of a project and that is 12%. Now this is more than your required rate. And suppose that the project is going to run for 5 years. You are expecting to receive a positive cash flow in year 1, 2, 3, 4, and 5. And you're making an investment now. There will be one IRR, for example, that IRR is 4. What the formula assumes is that when you receive the first cash flow in year 1, you will be reinvesting the same cash flow at the same rate right away. If you are unable to find an investment, another investment project that can give you a 12% return, then the IRR is going to be cheap. Now, why do we call this a problem or an issue with IRR? Because we may not be able to find a project that can give us the same rate of return. Yeah, it is also possible that we may find a project that will give us a higher rate than this project. But normally, what do we do with those cash flows? When we receive those cash flows, normally they go to the bank account. And they will stay in the bank account for some time, and the bank is not going to pay you a higher interest rate. So your reinvestment rate is going to be quite lower than the project. While the formula assumes that you will be reinvesting in cash flow at 12% at the IRR. So that's another, there's a problem with IRR that you need to keep in mind. Disadvantages, one of the things is that it does not distinguish between investing and borrowing. So when you use the formula, it does not really tell you whether this is an investment project or you have borrowed the money and you're paying back. Let's discuss that later on. We'll have examples of that. Secondly, IRR may not even exist. So you will put the values in the formula and you get an error. There may be something divided by 0, so there will be no answer for that. Or there may be multiple IRRs, as we discussed, plus and minus 12. Or in my case, there were only 2, but if you extend it to 3 years, there will be
So
a lot
more than 1 year is going to be difficult to calculate, right? That is going to be like power to the power 2, power
3, 4, it will become much more complicated. But luckily, we have got functions in Excel that we can use for that. And also problems with mutually exclusive investments. Now, this is a significant problem with IRR. Let's say that you are a finance manager, and you just know the IRR rule. Somebody told you, or no, you're not the finance, you're the CEO. And normally the CEOs will not use it. Okay, so what happens is that you only know the IRR and you know the acceptance and rejection criteria. What is the acceptance criteria? If IRR is more than your required rate, you go ahead. If not, you reject the project. So suppose that your finance manager analyzed 2 potential projects. One project, A, has an IRR which is equal to 30%. And the second project, B, has an IRR, this is IRR A and IRR project, that is 20%. And suppose that your required rate is 10%. Which project are you going to accept?
We can't decide.
We can't decide. Okay. Yes. Anyone else? A, because that is having the highest IRR. Anyone else? Woodbridge?
I'm not sure which one.
Okay. Okay, one of the answer is if these projects are independent projects, you can take on both of them. Because both are giving you a rate of return which is more than your expectations. So that is a good answer. But if these are mutually exclusive projects, you can either go for A or for B. Then you'll go for A because the IRR is much more than B. And that is that was the ranking criteria. The IRR rule tells us that we will have to go for a project that gives us the highest IRR. Now, if you don't understand as the CEO, if you don't understand how this IRR works, then you may go for this and there may be serious issues in this. Because this does not consider the scale of the project. What do you call that? Scale of the project. The reason is, for example, let's make it much more obvious. Let's say IRR of this project is 100%. Very, very attractive, right? But this project requires an investment of $5. So if you make an investment in this project, you will double this. 100% return means you will get $10 at the end of 5 years. But this one, project B, the investment is $5 million. And these are mutually exclusive. What that means is that you can either go for A or for B. Now, if you decided to go for A, you will make a $5 investment and make it 10. No, not in 5 years. In 5 years, that will be a lot more. Because 100% is per year. So in 1 year, this will become 10. So are you going to accept that? Instead of this one, and you also have the money to invest. $5 million investment in project B, and you get a 20% return on that. So what does this do, the IRR, is that if you simply have the IRR values and not the data at the back, this may be misleading. You will go for A because that is 100% IRR. And you will be ignoring the scales of these two projects. Now, the scale of project A is very small, while the scale of project B is very large. But this problem does not exist in NPV. NPV will actually give you the answers in terms of the accounting, in terms of the values. So NPV will tell you in this case, if this is a one-year project, we'll say the NPV is 5. But this will be an NPV of some, I think, hundreds of thousands of dollars. So of course that tells you the good picture. All right. Advantageous, easy to understand and communicate because the ranking criteria, the acceptance rejection criteria is very easy. All right. So now here's an example for you. Please take 5 minutes to do this.
To find out whether you need to accept it
you need to find the IRR of the project. And what you need for IRR is you need the cash flow, the present value, you need the future values, you need the number of years. Just do the brainstorming. And if you come up with an answer, that will be wonderful. Got it? You use the IRR function? Okay. Sounds good. So everybody can use the IRR function in Excel. Equal to IRR, and it simply asks you to select the values. And that's it. All done? $50, $100, $150.
receipt.
Yeah.
I think the 19%. It's going to be
Minus 200.
Oh.
50, 100, 150. Are you correct? I missed something.
correct. That's correct.
Okay, so this was 3 years. We don't need this one. Let me make this zoom in. So these are the years, and these are the cash flows. IRR, it looks to be very complicated when we're doing it, you understand, but it's very easy when you do it in Excel. So equals to IRR, and what is this asking for? Values and guess. You don't need to guess. You simply select the values. And close the bracket, and that is 19%.
19%. That's what you see right here.
I don't have
Oh,
that. I don't know how.
Did you guys on this move on?
How was that there? Yeah. But they didn't have the formula in an Excel spreadsheet.
However, you can also use the trial and error method. So what you can do is that you can calculate that is the IRR, simply using the IRR function. What you can do is that to find the NPV of the project, NPV, and suppose that we are doing this NPV. The rate is, suppose we use 10% here, and we see if this project has a zero NPV at 10% or not. It's not going to have a zero NPV at 10%. We know that the IRR is 19.4. It will have a zero NPV at this rate. Okay, at 10%, the NPV is going to be more than greater than zero. But let's do this. Equals to, we can calculate the NPV of this project. And remember that it is asking for the rate. And when we do the NPV, we have to select these values, if you remember, and add the initial cost at the end. Okay, we're not talking about this to the percentage. So in this case, the NPV of the project is 0. Now, if this rate is the IRR, then at this rate the NPV should be 0. But we know that's not 0. So we can increase this rate on trial and error basis and see what happens. So instead of 10%, we can say, okay, because it's not 0 yet, so we need to increase the rate. 15%, it has gone down, but it's not yet 0. What about 25%? Now it's negative. So that means it's between 15% and 25%, somewhere in between. So you can do a trial and error. For example, 22%. It is still negative. So again, it is going to be 0 at this rate. And you can check that. If this is equal to the IRR, then the NPV will become 0. And you got that. So you can also use the trial and error method. Or this one.
You guys do that one.
Yes, or this one? Yeah, so this is simply the NPV formula. And by definition, we know that IRR is the rate of return that makes the NPV of the project 0. And the rate that makes the NPV of the project 0 is this rate, 19.438. You can use the gold function as well. Yeah. You can also use some statistical techniques if you are more into paperwork and solving the formulas. You can use some statistical techniques.
When I get the 400,
you need to convert that from percentage to a number. The format on your computer is percent. Use the number. Okay. Right? All right.
You have to have 3.
So you just almost return not be able to reinvest.
Yeah, so that is one of the problems. So this is the assumption is.
Yeah. Yeah.
So you keep tracking like from minus 200 down.
Yeah, all these cash flows except the first one.
Oh.
And you add the first one at the end.
you were doing this.
That's right.
Select
You're
four
trying to get your IRR. Yes.
I was in PV with selected four.
Yeah, that would be incorrect.
So it's the same thing. Instead of writing all formulas, just write the PV and you have it. So four values next to each other is the same thing.
Sure. P equals to NPV, right?
Selecting over.
So the value.
Simply the values.
I selected all the values. Yeah, the rate and then the four values.
Okay. And then the values. All these values. I think it should be.
Yeah, just select 10% versus instead of 20. You will see that this code. Change it to 10. It's about 40 point something, right? So just 10, right?
Just 10%.
Oh, yeah.
Just write 0.1. Now is 0.1. First thing. This is it.
Right now. Okay, no, there's a difference.
There's a difference.
Yeah.
For instance,
So that's the problem with the Excel function. If you use that way, select these first, and then select then add the first one, you'll get the correct answer. But if you select all the values instead, you will get a wrong answer. So that is the difference. Okay, so all clear so far? Okay, now let's move on to do some further work on this. So the internal rate of return of this project is 19.44%, and now it depends on what your required rate is. If your required rate is 20%, this project is not acceptable. But if your required rate is 10% or below that, the IRR, then the project is acceptable. Now here is an interesting table, and I would like you to do this because we have done these tables quite a few times before. And then we will have to plot this graph. Now let me explain this to you, and then you will solve this in Excel. Now what we're trying to do is, it is the same project that we just did, the previous one, the same data that we used here, this one, okay? But what we're trying to do is to calculate the NPV of the project is these different rates. So NPV at 0% and 4% and 20%. Okay? And then see that where does the NPV of the project become 0? So do you see any point where the NPV becomes 0?
Yes.
It becomes 0 at somewhere between 16 and 20%. It is more closer to the 20% rather than, but we don't know exactly, but you can change these numbers, okay? Instead of 4, 8 interval, you can make the interval like 1, 2, 3%, and you will probably get a number of NPV which is very closer to 0. But anyway, that's not a big deal. You still know that it is somewhere between the 16% and the 20%, more closer to the 20%. And then what you need to do is to plot this. So on the x-axis of the graph, you have got the discount rate, which is this one. That is the discount rate, or the required rate, or whatever. And on the y-axis, you plot the NPV of the project. So simply make a graph. And what you will find is that this graph, it starts from $100 NPV at what percent? at a 0% discount rate. The NPV of the project is 100. But as you increase the discount rate, the NPV goes down. When the discount rate goes to almost closer to 19%, the NPV becomes 0. That is what the graph tells you. So in other words, this is the point where the NPV of the project becomes 0. And that is by definition the IRR. IRR is the discount rate that makes the NPV of the project 0. And that is here. And when we go beyond that point, when the discount rate goes above that 19.4%, the NPV of the project becomes negative, and the project becomes unacceptable. So can we do this? Yes, please. You should so
No, you're not typing. That's actually what you're trying to do. Yeah. That should be your NPV. Even now. I don't worry about that. All that stuff there. So right there is NPV.
now you were supposed to calculate it.
And then you're going to drag your up your just click on it, drag it down one. That's your what was that tag? Plus
You need to make this table, okay? So you can type in these rates, but you will have to calculate these NPVs using the table function in Excel. And when this is done, you will have to plot this graph.
So drag this. Everything else stays the same except for your change. So hit enter, and now your now go and click on that cell. Grab that, drag it. Got your name. Yes, on all change here. Now if you select this area, the percent trace, everything 0% to 617 dollars. Right? You might have a little bit. You can go to impact.
You can use this table.
Yeah. No,
Okay, let's do this together.
Better.
All right, so this is what we did. This is the same data. What we're trying to do is to find the NPV at 0% and 4% And then you can drag this down to, okay, up to 28%, whatever you want to do. So this is the NPV, right? What you need to do is to calculate the NPVs for these rates. And the data is the same. This is for 3 years project, and these are the cash flows. You simply need to select this table and go to the data tab and what if analysis, data table. This is what we have been using quite often. Okay? So this will give you the scenario analysis. But we're not changing any variable on the column. That's just a formula. This is not a variable, right? We're only changing a variable that was used in this formula, and that variable is the interest rate. And that is in the column here, so we're not changing anything in the row. We're changing in the column, and that is the interest rate. Which rate did we use? No, that is the IERR. So we use this rate, right? Enter it, and you got these values. You can put it up to 44. So now you can see that the NPV becomes negative between these two rates, and you can of course make the graph. Okay, you can copy this and paste special values. This is a rate, and that is the NPV. Select this and go to insert graph. We are looking for a line graph. So there you go. You got a chart. So is it correct? Something is wrong.
Yeah, you need a scatter.
Scatter? Okay. We need a scatter graph. This one? Yeah. That makes sense. Yes. So here you can see that this is the zero NPV, and the rate that makes the NPV zero is very close to this 0.2 or 20%, and we got that earlier. That was 19.43%.
Is there any reason why you copy and paste this chart?
I think he knows an easier way, probably. And the reason I copied and pasted it was this. If I have to write R, here is the variable, and NPV here, then everything goes wrong.
Because that's the formula.
Yeah, because that's the formula.
We could just change the series to the.
Yeah, you can do that. You're smarter than me. And what did you do?
I didn't, because I just created the formula and just drove it down. So I didn't, where, you're just changing.
Yeah, and you can use the labels later on. So you may probably, Halim, you may probably like to teach us that. Would you like to come here?
I don't need those.
Okay, so you mean like we select these two values and use the scatter plot, this one probably, and now it does not have any labels, right? So we can edit this graph and add labels. Probably there's something that we can do.
Yes, on
This?
No. Yeah, on a different axis. Go for it. And
would you like to teach us?
cannot be used in NPV fund.
Oh, trying to put a label on the with that axis.
Double on the chart, who's on the top there? Just something.
What in the format? Changing the type will just change it from like a scatter to
Change the layout. Yeah, this layout is the second one. But
no. I thought it was in.
this from there you can just
Oh wait, there we go. Yeah, you're right. Okay. Like. Depends on your version, though.
Yeah.
Because I think with the older version, like I said, when you double click on that,
Yeah,
on
it does.
those, and then there was where you could add titles and stuff.
Got it? Oh yeah, so you can add what that is. That is the NPV and the so x-axis is
It's more doing and right there. What is it? What do I do? Right there. Yeah, just it's supposed to work on
Access tile.
right.
This formula is
Yes. No, well, this one.
I can show the first one.
Yeah. You can.
And it says what is the for the what is the goal for the stuff? How do you put 10%, right? The R.
So basically, what it understands that it has to choose the goal.
Are different? Okay.
This is formula.
Zero and tell me what is this for. Put it towards the over what comes out this.
Got it. Thank you.
Change.
What, titles?
Just double click it to change.
Hi.
Thought I heard.
You should be able to format, right?
Lord.
And,
And it doesn't work, right?
right, okay.
No, it's right click,
And you
come in
edit the
here,
data series, or format the data series.
data series. I don't know why it doesn't allow me exceptions.
How to change the
Units, yeah, your units are too much.
yeah.
So, yes, yeah. So these numbers are this person. You know what it goes through, but it's no, it should be. Over here right now, it's right click, it should change. Just to say MPV over.
Okay.
Yeah, you can just your eyes.
But I think you don't need
Yeah, so
because you have not edited.
what is this?
You need to. This is rate.
This is R. What about the other one?
PV.
What was the name of that chart?
Chart.
Yeah, I was.
So, and then went to this chart.
No, I didn't.
This is the scatter plot.
I know how.
Okay,
Oh, yeah.
In this plot, I don't know for some reason.
Yeah, you have to go to select the data. They get in there when you do this, you can edit.
Yep.
Trying to write down.
I can just put this.
So, highlight, select all,
Choose
go to the dollar.
That's damn sexy.
You can choose.
There. But you're like an Excel guru. Okay.
Me?
Yeah.
Not that.
I'm more of an educated idiot.
Come on. This is, I can use.
Now you can change the name of the
Okay.
series, but I think
Let's go to.
okay. All clear so far? All right. Woodbridge?
Yeah.
Yeah.
Okay, let's move on to the next one. Calculating IRR with spreadsheets. So we've already done that, right? You don't need that. And you already know all these instructions, what to do and what not to do. So, problems with IRR, and I think we discussed that as well. But we're going to discuss to solve a problem of this. So one of the problem with IRR is that we may have multiple IRRs, and I explained that to you. How do we get multiple IRRs? There can be 2, 3, 5 different IRRs. So how do we address that issue? And in order to address that issue, if you have 2 or multiple IRRs, then that is not any answer. That does not give you any good solution whether to accept or reject the plan. So what you need to do in this case, you will have to calculate modified IRR. How do we do that? I will tell you in a minute, but let's discuss some of the other problems as well. Or why not? Let's do multiple IRR first. Okay, and then we have the borrowing or lending problem. We also discussed that the IRR calculation does not tell us by itself whether this is lending or borrowing. And we also discussed the scale problem. It does not tell us whether this project is a huge investment or a very small investment. It will just tell you the rate of return of the project. And also the timing problem. So we also don't know where do the cash flows take place. So we would rather prefer to have majority of the cash flows closer to the investment time. And if there are smaller cash flows in the future, that will be okay. But we would prefer most of the cash flows to be closer to time zero. But the IRR will not consider that issue. So now let's consider this thing. And we already know the mutually exclusive and independent projects. What are exclusive? That you can accept either A or B. Those projects are exclusive. And independent are if you have money and multiple projects and all of them have an IRR greater than your required rate, you can invest in all of them. But we'll be considering scenarios where we use the mutually exclusive projects. Now here is another problem. This particular problem will give you multiple IRRs. Now the nature of the project is something like this. You are investing $200 in the project at time zero. There's a cash inflow of $200 in year 1, $800 in year 2, and then an investment of $800 in year 3. Now look at the cash flows. How much are we investing in total? Just the accounting numbers. We're investing $1,000. Just the accounting numbers. Forget about the timing difference. And we are receiving $1,000. So that's one of the questions. Should we still do the project?
Yes.
We will have to calculate the NPV. The NPV may still be positive. We can look into that. And there could be other reasons as well. Even though it does not give us any monetary benefit, it may be a social project. So, for example, you belong to the county, the government, and you are a park, and you will be charging a fee, entry fee on the park in order to compensate for the investment. So even though you're not looking into a return, but you still want to have a zero NPV situation or something like that. But anyway, let's consider this and find the IRR of the project. Can you do that? Right now, you can definitely do that. Can you find the IRR of the project? Using Excel? Found any answer?
Zero.
So there's zero IRR. But in reality, it has two IRRs. Now, one of the problems Excel is just giving you the first IRR. So which one comes first? The zero IRR comes first. In other words, if you put these values in the NPV formula, the NPV will be zero if you put a 0% rate. Mm-hmm. But it will also be zero at 100% rate. Now, one of the problems with Excel is that when you put the values over there, it gives you an IRR of 0. But there's another IRR as well. Now, there are two problems. One, Excel does not give you the other side. And secondly, if there's the other side, there's another IRR as well, that makes things more complicated. Okay? Now, how do we know that a project may have multiple IRRs? How can we know that? The project that we considered earlier was also for more than 1 year. The criteria is that you look at the cash flows. If the sign changes from minus to plus more than once, then you should understand that there may be more than one IRR. So here, you're making an investment and then you receive the positive cash flow. So the sign changed from minus to plus, but then here it changes from plus to minus again. So there's a twice sign change. There's an investment needed twice during the course of the project. Now, if that happens, that is an indication that the project may have multiple IRRs. Now, when you use Excel, that gives you a 0, and of course, you're not going to accept a project at 0 IRR. But you can then use the modified IRR technique as well. And let's look into that. Modified IRR. What you need to do is this one. It is very simple, the technique. Whatever the positive cash flows are, you need to take them to the future. Find the future value of the positive cash flows. Okay? So these two cash flows are positive. You will find the future value of these cash flows. Let's say this becomes future value at time 3. And you will calculate the present value of the negative cash flows. So this one is already in present, but you will find the present value of that cash flow. Now both of you are negative. This is PB. Now what you have there, this is a situation, a negative PB and a positive FV. You can use these two values to calculate the IRR. And that is going to be the correct IRR. Yeah, I understand it's difficult. Let me explain that to you one more time. So, what was this like?
0, 1, 2, 3.
200 minus
200 plus
200 plus
800 plus
800 plus and 800 minus. The reason I'm writing them down up and downs is that we should have them on one side. Now, this is time 3, and this is time 0. This value is already in present. What we need to do to find the modified IRR is to bring all the negative cash flows to the present and take all the positive cash flows to the future. So this negative cash flow is already in present. We don't need to do anything. But this one has to be brought to the present, 8, at whatever borrowing rate or whatever you know. But yeah, this has to be at the borrowing rate, because if you look at the data over here, the instruction is that first calculate the net present value of all cash outflows using the borrowing rate, and the future value of cash inflows using the lending or investment rate. Does that make sense? So if your borrowing rate, let's call that BR, is equal to 10%, and that should, for example, is your minimum required rate, and your lending rate is, or investment rate is what you require, is 12%. Then you'll have to use that. So using the 10% borrowing rate, you will bring this to the present. Using the formula, present value equals to future value divided by 1 plus the borrowing rate raised to the power n, and n in this case is 3, right? Future value is 800. And these two have to be taken to the future. Now this one is not, this is in future, but 2 years in future we want this at the end of the project. So this has to be compounded for 1 year. And the compounding formula, future value, is equal to present value multiplied by 1 plus, in this case, the lending rate raised to the power n. What is n in this case? We are compounding this for 1 year. And similarly, this cash flow has to be taken to the future as well. So you will compound this for 2 years to get its future value at the lending rate or the investment rate.
So for minus 800, what will not be our n?
No, this n, we are compounding this for 1 year in order to take this from year 2 to year 3. So we are compounding this for 1 year. Make sense?
When you said we have to take minus 800 to the present, that's using
That is 3. Yeah, that's
3.
because
right?
we are discounting this
Yeah.
for 3 years.
Okay, that's what I'm
Yeah.
Do we have like options of compounding after the year 7? It's always going to be happening.
Yeah, there will be situations, but in this case, we are considering a simplified example. Yeah. Well done. Can I have the values then? The present value of this future cash flow is, what is that? 601, and that is again negative. So the total investment in present value is minus $801. Similarly, what is the future value of the 800? It should be more than 800. 800? 896. And what is that one? Compounded for 2 years? 250. So what is the total future value? That is 6411. So now this is the future value, total future value, and this is the total present value. Now what you need to do, you've got one future value, one present value. You can now calculate the IRR of these two numbers. That is going to be the IRR of the project. Can you do that? So we have got two cash flows, times 0, 1, 2, 3. There is an outflow of 801, and there's an inflow of 1146. And say that your investing rate is 12%. Do that in profit. Which one?
the second.
This one?
200, yeah.
So using this formula, this is 2 years away from the future, right? So you need to compound this for 2 years. So raised to the power 2, and the rest of the variables. Present value is 200. The lending rate is 12%. And number of years are 2 in this case.
So for 800, only 1. Yes, right?
Yeah, for that one, that's just 1 year because we're compounding it for 1 year. So did you get the IRR? 43%?
It is a lot because the numbers are 10%, 12%. That's the difference. Still 43 is too much.
That's too much. We need to look into that. Anyone else?
Wait, so it's 43% right or wrong?
I don't know. It seems a bit too much.
Okay.
Given the data, it seems...
But 43% is the difference between these two numbers. And if you put it into Excel IRR, then it gives you 43%.
I think you're not considering
Because
the...
like it is just 2 years.
I think you're not considering the years.
Yeah, you should put this in 3.
Yeah, we're doing it for
So we should
So in order to do the IRR, when you put this data in Excel, you put so 0, 1, 2, 3. So minus 8 or 1 here, 0, 0, and plus 1146. And then select this whole series. 12.
13?
Yeah, that makes sense, probably. Yes.
I did the MIR formula.
Yeah, you can do this. You're smart.
With those zeros, it change transport.
Okay. All right. Then find the rate of return that equates these two values. Benefits of MIR is a single answer, and that's most likely going to be correct. So now you understand how to do it. And Tricia also uses smart technique to simply use the MIR function. Okay? But it's always good to understand the methodology and then use the shortest technique. All right. I think we need a break, don't we? You tired? Okay. All right then. Let's take 10 minutes break, more than 10. I'll be back at 8:05. Okay? So we have a break until 8:05 by this clock. And let's check that.
Is it great?
Yeah, it's not really updated. The last thing I had is like 5.
Yeah, but on the side, like you go into Google, right?
Yeah.
Click on the side.
The grades or administration.
Fine. So that's like 15 minutes.
So IR and the MIR formula is the point of view.
Yeah, but I have one.
Yeah.
I don't think nobody will.
Yeah. Yeah.
For registration, I don't have a process. So, yeah, for next quarter, we said that. Come on, then, I think.
He ain't working on that stuff. And then he just like went into Google, type it out,
Figure out how to do it.
then poured it out there. You know. Not,
So your interest rate, there's a RRI.
So,
it's colors. just watching this movie, Michael Jordan class, right? And we got to a certain part, and she stopped class at 9:00. So I don't think I did that.
Oh, trying to, yeah.
Then come with part of our classwork. So when I don't understand that, I understand this. You know what I'm saying? I understand. I'm gonna finish this so I can write my report.
Well, you need the exponent, and then you put parentheses, 1.54 puts the parentheses. Exponent, shifts.
Oh, yeah.
And then parentheses. This 1.1 divided by 4, 1 point goes it, and then you might need to get the extra parentheses, that whole set. Yeah, so, and yeah, change that to a percentage. There's also this right here, that button. You just click that, and you get your dollar percent. So, what do you want? Or you have the RRI function.
I like this.
Yeah. Well, no, this, what I understand is it's part of the funnel. It's done. Maybe a longer design. Yeah, I mean,
Organizational change.
Oh man, that's what I just got out with Dr. Jordan.
Oh, is that
really
really?
good?
Yeah. And legal environment.
here's your, you guys go home, do this, blah, 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 now, already, but, Excel, already done in there. Like, because they're not done for tab instead of stuff. Then I'm just going to copy those.
I got what's the thing?
Oh, Redmond. That's who that doctor is.
Yeah, exactly.
Oh, the research method?
Yeah, anything?
Yeah, that was the first class. Are you on?
Online.
Yeah. Who's your teacher leader? Oh, okay. That's who I had too. Because the one, whoever I had, I can't remember her name now, but she was not. She just wasn't tech savvy, and it was like you had to build an app, and so like she couldn't even figure out how to do like anything you would ask her, like any question to help you, like because I'm not a tech person either.
Right.
So trying to like figure it out, like other people, like actually that one of the guys in class that helped me like figure out how to do that. I had no idea how to do that. It really helped me, like, and then finally, like, because like you're supposed to put Excel spreadsheets in the app, and that's what I couldn't figure out. So I guess there's certain apps that allow you to do that, and certain apps that don't do that. I had chosen one that you can't do that. So I was trying to figure it out, and I couldn't figure it out because it's not possible.
Okay.
But so like even trying to ask like a teacher, like she was going to,
So for the so how did you get a grade on it?
your final grade was the app. So like throughout class, like
Build into that.
you do like Excel. So you had to write like a case study review type thing, and all of that got put into your app. So it really wasn't like, it was just basically click on your app and like your document. Like that's all it was. But figuring out how to put it into the Excel document. I can't think. I think I did an app maker. So remember that app maker? I think the one I used.
I might have to get another computer. But this is
No.
yeah.
Not gonna be.
I'm gonna try that. I hope laptops are pretty cheap. Because I mean, pretty much after class, that's it. I try to do everything at work. You know, I can't build an app on my computer, but I do all our work at work. So
Even like the app, like all it is was like a website.
Oh, okay.
Like all you have to do is like, I don't remember how I did it now, but maybe just like upload your document. Maybe have like a thing. You know how you uploaded your assignment?
Yeah.
It was pretty much like that, but it was just like a website. Like you just had to sign it by creating an account.
Oh, okay.
And then, so it wasn't anything like, I think you should still be able to do it at work.
All I need is like 20 minutes.
Oh, just food in his class. I forgot that we wanted to 2:50.
Oh, right.
Man, I was like, you always have food. She's like, yep.
Yeah.
I would.
Like
kebab, something.
No.
Right-handed thing.
with this,
Alice, something.
Like,
Where the gym is.
oh, really? Oh, there is a
superpowers,
picture there? Okay. Not good at all.
No. I mean, yeah, they're definitely, that is the worst. And the guy told me, I said, it's really good. I said, all right, I went there, right.
No, not so much.
now you have to discount it.
Read over something, it's pretty good. And things. That's back to Jordan class yesterday.
Oh, really?
The pizza cheesesteak. That was changed. It changed class.
You changed it in class with her.
I did watch this movie. Man, that was a really good class. Because the whole group, but she had to do every day, had to write a journal. Every class, she had to write a journal on change, you know. Like, it could be any kind of change, right?
Yeah.
And I, with me, you know, once I got into class, I started trying to figure out where were we. And finally, I started making my changes because they have to have 8 up. So, and this was the movie before after that yesterday with pizza and I didn't see the end of it. And I'm like, you know, hey, I want to stay.
Yeah.
Yeah. Before it's 0, so it's 5 plus the discounted rate, the discount rate, now divided by the discounted cash flow of the next year. Right. Should be 5 something. Or if I look at wrong.
Yes, the second class.
I got 5.3. That's that should be the 150. Make that a negative. That's fine. Because I do a plus minus. Because it's on the H107. Yeah. Because it's a negative, I really want it to be a positive.
Always throws me off like a split second.
But all of us, well, all of those answers upon the excess spreadsheet.
Yeah.
That's
And
a
it's
lot.
like, he's like, you got the answers. He's like, you just got to figure it out. The Excel sheet. You're not like the week one assignment, right? You know? And I was like, that. So I don't know, I'm gonna look at it again. But
But one of those things, I mean, like last week it was like 20 to that's 10 ounces.
that's a lot of questions.
You know.
So I don't know if that. It's like I had to have him repeat that because like he said something, but then he got like all choppy. I was like, wait, what you said? And then so I don't know if he said that we were gonna have an assignment tonight, or if it's just gonna be we'll just have a final. Well, yeah, that makes sense. We should go to the final.
So,
Yeah.
So,
And then value. And well,
That's easy.
right. That's
Now
what
that's
she said.
like
That's a lot.
I got 4.65.
Yes, I do understand.
So that is true. And that's why I said, you're worried. I'm like, well, I'm kind of not really going to wait until next week because I had a something. Like, you're already said he took over homework for convention. And he's going to come up with a grade. So I don't know. He was going to come up with something. That's why I'm like, I'm not going to yeah.
so why did that one next day over there?
Because of the last. The last.
So, yeah. I mean, like I said, it's really
You're right. For my organizational change meeting online, it threw me off. Because with being off in this class, he wasn't here 2 weeks ago or whatever. I was like, yes, but that's what we told it on. I'm thinking that this was done, or this was the last class. I'm like, why is she? She goes to her introduction.
Who's the name?
Fournier.
Oh,
I
no.
think, but it's just so she posted that, she posted how assignments would do, how all the materials posted, and I'm used to that being a couple days before, or a week before class starts. What are you doing, Lynn? At least I can, if I do it, I can get ahead. She has everything posted, but.
It was pretty good.
Yeah.
We had a lot of good discussion. Yeah, German, they talked about
Oh, yeah, I understand.
it.
A couple times.
Yeah.
Sitting there late because of him.
His views are just totally crazy.
Yeah, and he's very strong. I mean.
Because you was in the class.
Yeah. The last, yeah. I
can't remember what they got. Gun control, I think is what they're.
Yeah, I wrote the paper, right?
Yeah.
You know, and then she asked me, after class, she asked me, said, how come you didn't say anything? I said, because he didn't say anything.
Yeah.
You know what I'm saying? I mean, it wasn't an argument. Everything was in the paper.
Yeah.
So then we get to this class, right? And he says that all the stuff on gun control and all that stuff. And I was like, that's the point. You know what I'm saying? That's the point of the paper, you know what I'm saying? You know, are you listening to yourself? You know what I'm saying? It was amazing to me, man.
Yeah.
So look, so he comes in and he said, oh, I got a crazy neighbor. They don't work. They're Africans. They don't do this. They don't do that. You know, they don't come outside. They yell at night and all this other stuff. I said, well, maybe they see you blow up on your house with your tattoos. That's why they don't come out, right? Yeah, but then he was like, what do you think I'm racist? I said, no. I said, you said they was African. I'm just giving you a reason why they might not come outside.
You can just, like, everybody can look at people, and you can be scared of whoever. You can be scared of Asians, blacks, white, whatever. Like, just when, like, you see, like, your vision of an intimidating person or whatever.
Yeah, I said, these people from Africa, you don't know whether they come outside or don't come outside. You know what I'm saying? I said, just like you looking at them, they could be looking at you. You know, you think I'm racist? No. I said, that's not even it.
I can see that argument going on.
Yeah, you know, I don't talk that much. So I was like, no, not really. I'm just saying, these are people that you are a person, you know.
Yep.
If you knocked on their door and took my apple pie and said, welcome to the neighborhood, you know what I'm saying? You know?
Exactly everything you're saying. Think about how someone else can say the same.
Yeah, you know. Hey, we're here. This guy got all these tattoos by the motorcycle.
Because motorcycles aren't that common either. You know what I mean? Like, you see, like, you know, you're from a different country or whatever. You see,
Yeah,
that's not normal.
He's a hell angel kind of guy. I mean, all this stereotypes.
Yeah.
Yeah, me and the guy was at work, right? And I think we was talking about different. He's right, and I mean, reserves man. But we got that military mind.
Yeah.
So he said he went to McGuire to VA for some stuff, and he said, man, I took a wrong turn, and you know, I said, I'm like real black neighborhood.
Yeah.
He started seeing the white cross the way, blah blah blah. I said, isn't it amazing how we get nervous?
Yeah.
Right? I mean, we was having a conversation, right? I see, you live in a black neighborhood, you start getting nervous, right? I said, I can go to a discotheque with 1,000 white check 1,000 white. I said, but if I go into a country and western bar and see two guys in there, that damn country and western, I get nervous. You know,
you're right. Like,
we just thinking, you know, tripping off of that.
Yeah, that's great. Yeah, like I've never really thought about. But yeah.
You know what I'm saying? I said different things and make us nervous. But that's how I was saying to John. You know, I was like, you know, if that's what you think, then, you know, that's on your mind.
Yeah.
You know what I'm saying? Like, you know, I said, people, you know. So, but,
I think people forget that too, though, because I never really thought about that. Because I get scared going through certain neighborhoods sometimes, especially like if I don't know it.
right.
It's like same thing with other people, like just don't know, don't. But I think it's definitely think all of that.
But that was a good plan. You know, I'm doing silent experience capstone.
No, I don't even know anything about it.
Okay.
Like I know it's like you know, like all encompassing whatever, but
Basically, with a capstone, it's like most of the class, business. Okay. So you have to come up, you know, say you want to get some type of business. Then you can start off with your model, how you want your business to be, business, this and that. So that it'll be viable business.
yeah.
And the capstone at the end of the presentation of,
Okay.
you know, so say you want I don't know, computer.
Yeah.
Anything. So you have up your line of business, how you going, and then all the thing about all your classes that you're taking.
Kind of full thing.
It's pulling all this stuff
Sometimes I
from
from my
that.
bachelor's, I wasn't sure I could assume like exactly what they would, you know.
But it could be anything.
Yeah.
They don't have the thing about kids, they don't have a structure. Like, I mean, not like a structure, but they don't say, okay, this is what we want.
Yeah.
And that capstone is whatever you want it to be.
Yeah.
So it's
Very
unlimited.
broad, yeah.
It's not like they give you this.
Right.
It's okay, make a cell phone company.
Yeah.
You know what I'm saying?
Yeah.
It's not like.
Huh. So like, when you say present it, like, you actually have to like present it to your class, or is it just like
to the doctor's
okay.
or whoever.
Like verbally, or you just like turn from the page?
You can do both.
Yeah.
You can put it into movie, but you have to do it in stand up.
Really?
But that don't have to be like a long drawn out thing.
Yeah. That's what makes sense.
Because I'm doing videos,
Yeah.
right? And all I'm gonna do, right? And I'm doing my other degree is in other management. All I'm doing is service. I'm under
Yeah.
with some different kind of drinks, and let them watch it.
Yeah.
That's all I'm gonna do.
Good.
That's
Yeah.
so I'm not gonna talk at all.
So what's your videos then? Like, are you like?
Well, my thing is I'm doing single fathers. Like, okay, an example is like a lot of people think that single fathers, when we get our kids, we used to feed them hot dogs, hamburgers, and stuff.
Mm-hmm.
Well, I'm saying, we as a single father, I teach you how to cook, and you communicate with your kids, sit down and talk with your kids, how to do things, through cooking. I'm trying to have the bridge of communication, with single fathers.
Yeah.
Because, we get our kids like on the weekend or every other weekend, wherever the court decides.
Mm-hmm.
So we miss a lot.
Yeah.
And we got to compact it all into that weekend.
Right.
Or those 3 days
Yeah,
or 4 days,
yeah.
you know what I'm saying?
Make up for all that.
Right. So with cooking, so we'll learning how to cook or showing you different things to cook. The kids can come in the kitchen and have the hours to so on. So we go from there.
So are you just like pulling videos from? Or you're making
Yeah,
like,
making
so, okay, so are you like interviewing people, or are you being like you in the kitchen? Like,
Yeah, I'm in the
making-
kitchen
okay.
and I'm just showing.
Gotcha.
I'm just saying.
That's a really good idea.
Yeah, I'm just saying, okay, hey, kids come over, and a lot of people, we're taking our kids we're not taking kids to our fixing meals. We take them off McDonald's, or we can come over, we got pizza, or we got hamburger,
Right.
And I'm just saying, this is what we communicate. You know what I'm saying?
Right, that's a really good idea. I think that's going to turn out really good.
Laugh.
So how much left do you have left then?
I have 4.
Okay.
It was amazing. I walked in Dr. Jordan's class, and it seemed like yesterday.
Yeah. Yeah.
It ain't really changed.
Yeah.
And she was my teacher twice.
Yeah.
I had her for Monday class and I had her for Wednesday class.
Oh, okay.
So it seemed like I never. And this is the first quarter that I don't have coming up. That I don't have.
Really?
And I was when she was going to do the capstone on this one, but I'm not ready. And I feel like I can get a very good time to play and all this stuff. It gets my.
Oh, your videos. Okay.
Yeah.
Gotcha.
Yeah, that's.
A week, maybe a week and a half or something, sometime between.
Past 30.
I'm thinking that now.
Like Tuesday.
Yeah. I might hit you up and be like, yo, this was thing new.
Yeah. We have, it's modules. F5 after 8.
Did he go? Did you guys do this new lady?
Yeah, we were there.
Someone's here, I don't know that.
Yeah. I called it quits. I'll just help them do so. Okay.
Why is it, why is it staying here? Oh, I see, because it's not so that's it. Okay.
I'm too late. I actually tried to reply an email and I didn't realize.
So what do we have with the final exam or final?
Okay, let's talk about the final exam after we
Yeah,
finish.
let's talk about.
Because that's what you were interested in. Okay. So now you know how to calculate the modified IRR, and you can also use the Excel function to do that. So that is now clear. And in case of modified IRR, you have just one IRR, and you can take a decision on that. So that will be the accurate answer. Now, the scale problem, we discussed this earlier as well. So here's the question for you, and it's pretty much the same thing as we discussed earlier. So would you rather make 100% or 50% return on your investment? Of course, you would prefer the 100%, right? But what is the scale of the investment? What if the 100% return is on $1 investment? And the 50% return is on $1,000 investment. Of course, you will go for the 50%. But when you calculate the IRR, it will simply tell you, hey, we've got two projects. One is having 100% IRR, and the second one is having a 50%. So if you don't know the dynamics in there, you may ignore the scale of the projects, and you will go for the 100% IRR, which will be misleading in that case. Also, the timing problem, we also discussed this. So look at this one. We are making an investment of 10,000, and the cash inflow at year 1 is 10,000, and then we are receiving 1,000 and 1,000 here. So that is a total inflow of 12,000, right? Investment of 1,000, inflow of 12,000. Of course, you will have to bring that to the present to take the decision. But that is the situation in project A. Project B, again a 10,000 investment, which is the same as the investment in project A. But look at the cash flows. We are receiving a very small cash inflow in year 1 is compared to the 10,000 there. That's a huge difference, right? And then a 1,000, which is equal to that one. And at year 3, we are receiving a significantly higher inflow in project B is compared to project A. So look at the timings. Now, if the total cash inflow in project B is larger, isn't it? Mm-hmm. We're receiving 14,000 inflow for having a 10,000 investment, and in project A, we're receiving 12,000 inflow for an investment of 10,000. So if you just go for the accounting numbers, you may prefer project B because that is giving you 14,000. But when you take the time value of money into consideration, this 12,000 that you're expecting to receive after 3 years, that has to be discounted for 3 years to bring it to the present, and it will become much smaller. But in this case, the largest cash inflow is taking place after 1 year, and if you discount it for 1 year, well, there will be a difference. So the timing problem, the IRR may not give a full consideration to the timing problem. So look at this one. It's based on the same data that we are considering. So for project A, this is the situation. This is the discount rate, and these are the NPV values. So look at this. Where does the NPV become 0? So yeah, that is over here. And this is closer to some 28, 29% discount rate. Okay? Now, what about project B? Project B is having a much larger NPV because the cash flows are very high. But that larger NPV is at a very smaller discount rate, that like closer to 0, maybe 0, 1%, 2%, up to this point. Or something closer to 10, 11%, something like that. Now, at this point, if the discount rate is below that rate, which let's suppose call it the crossover rate, because these two projects cross over at that rate, and that is 10.5, we have done the calculation. If the discount rate is less than 10.5, then project B is better than A, because this gives us a larger NPV. But as soon as our required rate goes over 10.5%, then project A becomes more favorable. Make sense? Now, what is the reason for that? The reason for that is that if you look at the cash flows of project B, the larger cash flows are taking place towards the end. And when you apply a higher interest rate, discount rate, to a larger cash flow, that will be discounted significantly. And that's why it becomes smaller quickly at a higher discount rate. Now look at the IRR of the two projects. The IRR of project B is somewhere 16, 17%. Yeah, it's here. Yeah, project B IRR is
12.9.
The is that correct?
1,000.
Oh yeah, sorry, yeah, it's this point, not that one. It's this point. So that's 12.94, and for project A, that is 16.04. And both the project B becomes not unacceptable after 12.94, because in that case the NPV then goes to negative. But project A is still positive. So it depends on what your discount rates are, and if you look at that, it all depends on where do these cash flows take place. Even though in accounting terms, the cash flows of project B are much larger than project A, but if your discount rate is for example, over here, 13%, you're not going to accept those larger cash flows because they will be discounted significantly.
Here, discount rate, right for borrowing. Borrowing or
This will be our required rate.
or
Yeah, so required rate is our investment rate. Yeah. Okay, so which one is better, NPV or IRR? Yeah, I think that's the easy answer. You don't have more complications in NPV. But if you use IRR, you'll have to take all those other factors into consideration. But NPV is just a straight decision. However, the NPV and IRR will give you the same, will take you to the same decision if there's just one IRR, or in other words, if the sign does not change in the cash flows more than once a year. Good. So that will take you to the same decision. Exceptions are non-conventional cash flows. In other words, if the cash flow sign changes more than once, then you will have multiple IRRs, and there will be the other confusions and a lot of other things. However, still, I would say that even if the sign does not change, the IRR has limitations. For example, it does not tell you about the scale of the project. NPV does. Right? And also the timing of the project also, that is ignored by the IRR calculations. Also, in case of mutually exclusive projects, that may be misleading as well. So initial investments are substantially different in the two projects. Like that means the scale of the projects, in other words, and also the timing of the cash flow, which we already discussed. Any questions so far?
Still, that's great. Even that rate is investor internal investor rate. The higher the better. Why is that the higher the worse?
Can you say that again?
Could you go back?
Yeah, sure. Here.
That chart.
Okay.
Mm-hmm. You said the rate is more than 16 or more than 12. Mm-hmm. The investment will be negative. The profit will be negative.
NPV will be negative. Yeah. Mm-hmm.
I don't understand. I think that rate going higher, the NPV should be positive.
No, actually, this rate is not the IRR. IRR is just one for both of them. For project B, here is the IRR, which is 12.9. And for project A, the IRR is here, which makes the NPV 0. So and that is 16.
So that's 0% to 40% to be then.
These are the different scenarios. So what if the discount rate goes along this continuum?
So my question is discount rate
this is a required rate.
Required can I say it is like a borrowing rate?
Well, you may call this a borrowing rate. Different, you have to define that. Or in other words, it depends on what you consider to be your required rate. So for example, for me, I have borrowed money from a bank, and the minimum requirement for me is to find an investment where I can earn at least what the bank charges for me. So for me, that is my required rate. For you, you're not happy with that. You say, well, I have borrowed at 5%, and I need to find an investment that pays me 8%. so that I can keep the 3% in my pocket. So for you, that is the required rate. Understand? So this continuum, this x-axis is actually telling you what if your discount rate is here. So let's say for me, I am happy with a smaller discount rate. So in this case, if my discount rate is less than 12.9, let's suppose 8%, then I will go for this project because it gives me a larger NP. But your discount rate is, for example, here, say what, 15%. So for you, the project B is better because in that case, that one has the larger NP. Sounds good? Okay. Okay, profitability index. This is very easy, as I told you earlier. What do we do? We know the NPV. I think I need to make this formula. Yeah. So, you know the NPV formula. What was that? NPV is equal to present value of future cash flows minus the initial investment. In profitability index, you simply not subtract but divide it. So present value of future cash flow, this, in other words, this is the benefit. Okay, the inflows, the present value of the inflows. And the initial investment is the outflow. In other words, that is the cost if you make it simple for yourself. Now, this profitability index, if let's say if this is 2, what does that mean? The benefit is 2 times the cost. And of course, that is a good project. So as long as the benefit is more than the cost, you will get an answer of more than 1 here. Sounds good? And that is a favorable project. But if the benefit is smaller than the cost, then you will get a number less than 1. And that is not acceptable because cost is more than the benefit. So what is the criteria for acceptance? If the profitability index is more than 1, that means benefit is more than the cost, you will accept it. But if the profitability index is less than 1, then that is a reject. And if profitability index is equal to 1, then that is a win-win situation. But again, keep in mind that when you talk about this benefit, you have already considered your required rate. So even at 1, this project is meeting your minimum required rate. So even then, you will have to go for it. So again, this can be compared with NPV. If these two are the same, then the answer is going to be 1, right? And this minus this, the cost minus benefit is going to be equal to 0. So when NPV is equal to 0, then PI is equal to 1. So they give us the same decision criteria. Similarly, if NPV is greater than 0, then PI is greater than 1. And that is a favorable project. And similarly, if NPV is less than 0, PI will be less than 1. So that will take us to the same criteria. However, the profitability index again has that scale problem. Make sense? Because when you divide these two numbers by each other, it gives you a ratio. It does not tell you how big these two numbers are. Right? So if your assistant gives you the number, hey, we've got two projects, one has 2 PI and the other one has 1 PI. You may go for the 2 PI, but that 2 PI may be a $4 investment and $8 in present value benefits. But the one may be much larger in that case. So you have to keep these things in consideration. Again, disadvantages mutually exclusive investments because it does not tell you about the scale of the project. And the advantages that it's very easy, in other words. Okay, tactical capital budgeting problems. Now let's, yes please.
For the PI formula, it's total present value of future cash flows by initial investment. And there was a case when we had minus 200 in the first one and then minus 300 in the last one.
Mm-hmm.
So what do we do with that? Then we just consider the 200 and 300 as like get it to the present value, or do we consider it?
Yeah, I think that equates everything. So let's say you have an investment in the future, so there will be a negative case. Mm-hmm. When you bring that to the present, it will be a smaller negative. Mm-hmm. And it will be subtracted from the benefits.
Okay.
So it equates the things.
Okay. So we could use it either ways. It's going to be the same.
Yeah, it's going to be the same, yeah. It's not good.
So we can do it the same way we do it for the IRR.
No, not really.
No?
So you can say in this case, what we're talking about is present value of the future cash flows. Mm-hmm. We're not talking about future cash inflow. There may be outflow or inflow. So whatever. So if that is an outflow, okay, that's automatically a cost.
Yes.
But it is already, if you add it to the other benefits, mm-hmm, it is subtracted from.
That's correct. So it doesn't go under the initial investment.
No, it does not go under the.
Because it will be different. Because it will change the.
Yeah, it will change the ratio.
Okay.
So simply the future cash flows find their present value.
Okay.
And divide it by
the cost. Negative, doesn't matter.
Doesn't matter.
And can we say when NPV is equal to 0, PI is equal to 1, and IRR is equal to R? Is it true for all the cases?
Yeah, that should be the case. Given the situation that when IRR creates complications when the sign changes. So when the sign does not change, this will give you the same criteria. When NPV is 0, PI will be 1, and IRR will be equal to R. Correct. Good observation. So all these criteria, all these techniques are related to each other.
So all of this formula didn't consider reinvestment under the risk-free ratio.
Reinvestment is an issue with IRR. Yeah. But for the others, it may not be a big issue. But we assume that we will be reinvesting the same cash flows in the same rate. That's the assumption. If the assumption does not hold, then your calculations will be misleading.
Because generally the company have a return every year, huh? most of them throw the money back to
the same project.
Same project.
Yeah, so that can be done.
So those formula, the calculation didn't consider this situation.
Well, the formula actually considers that you will be making the reinvestment either in the same project or in a different project at the same rate. Make sense?
Also, there is no risk-free value because different projects
have different risks, and they may have different returns.
Yeah.
Yeah. So again, I mean, like that is an assumption, and assumptions may not be true all the time. But this is a limitation in case of IER, and the other techniques are okay with that. All right? Okay, so here's a question for you. we've got two projects, A and B. Then you need to calculate the IRR, NPV, and profitability index of the two projects, and you may also want to calculate the payback period. So as soon as you're done with this, you'll be done. Okay, for AB we need it. More than one? No, that is the total. Okay, let me show that. Okay, let me tell you one more technique here in Excel. So if you have to find the profitability index of okay, so if you have to find the profitability index of this project, excuse me, can you give me 1 minute? In order to calculate the profitability index of this project, what you need is the present value of these future cash flows, right? So you can simply use the NPV function. Okay, what was that? It is asking for the rate, which is 10% in this case, comma, the values, I will select these values. Now, the problem with the NPV function was that when we calculate the NPV, we have to add the initial cost after the fund. But if you don't add that cost, it simply finds the present value of the future pay. So that is the present value of the benefit. And divided by the present value, so that is a negative, we need a minus sign in order to make this positive.
Instead of adding it, we just divide.
Yeah. So that is 1.0.
That's divided by.
Divided by the initial cost.
Negative.
Yeah. And negative in order to make it positive.
That was the 1.3 plus the.
Visible now?
Go back to more. Oh, okay.
Could you go back to the question? Forget.
Okay.
Oh, this one. This one? Is that what you're
Yeah.
Okay. I thought you were looking at this. I was like, oh wait, that's not right numbers.
So,
It's just in the 10% and divided by,
Yeah, that's great.
All right, so let's talk about the final exam. Okay?
What things?
Final exam.
Yeah, one thing I wouldn't-
All right, this is a serious business. Let's talk about this. I will be posting that on Moodle, and what I require you to do is that whatever questions I post or require you to do for the final exam, you need to do them in Excel. Okay? Properly labeled, question, chapter, and everything. If you can do the highlighting and orders, whatever, I think that would be a bit too much, but at least I should have a chapter and the question number that you're trying. The data should be extracted properly. And I need all the formula links used. So if I require you to do all the questions, that would be, I think, a bit too much. But I'm going to include some of the questions on IERR as well. This will be an assignment week, assignment 2. But it will be most of the assignments that you have done so far. Okay? So what you simply need to do is to solve those assignment problems in Excel. And I should see the relationship. If you've already done them in Excel, just format it according to the requirements of the final exam and submit it. If you have done them in Word file, and by the way, you've already got the solution, so you can use those solutions, but I need to see that, well, you really understand how we got those answers. So you should put them in Excel, and I should get you.
So it's going to be on the line.
Yeah, you need to submit it as an assignment.
Oh, you need to submit. When do you post this?
I will post this maybe tomorrow.
So what is the time frame?
I will meet the final exam by Thursday midnight.
This
This Thursday?
No, coming Thursday.
Oh.
Make sense?
Yeah.
And for that,
So it's going to be on top of the assignment.
yeah, it's gonna be sort of this time.
So how many questions? We have like 8 assignments so far. Yeah. Yeah.
Yeah. So with pretty much everything.
Everything?
Yeah, but I will tell you. That's going to be a lot of work if you have not done it in Excel.
If it's not done the assignment in Excel, right?
Yeah.
Because not all of the assignments were in Excel. We have to do something for it because it's like explain.
Okay.
Yeah,
You
because some of
simply-
my assignments are for.
Yeah, you simply need to put those numbers in Excel. But
But if
I'll
they're
not
in
include everything, just select it.
Yeah, but if they're in Excel, and say for example, we've used the formulas, if at times we've used the Excel functions, at times we've used the algebraic formulas that we use here, or maybe there is a different connection, but you've still done it in Excel. So does that make sense, or do you need to do it all of
Over
them
again,
in the
yeah.
same connected formulas using the Excel function?
Well, each question should be calculated to all the Excel formulas. So you can make your own formula. For example, in order to calculate the present value, you can either put in the formula future value divided by 1 plus I,
Exactly,
whatever, or you can use the Excel function for present value.
But you can have mix of both as well, right?
Yeah, you can have mix of both as well.
So how many questions?
I think there's going to be a lot.
But it's going to be the same question amongst the assignments, not any different.
Not a different question. It's going to be the same question.
Yeah, these are going to be the same. Sound good?
Yeah.
All right. So what, Bruce, are you clear about that?
So I'm getting bits and pieces there because it is kind of broken up a little bit. So are we going to have to do every single question that we've already answered in Excel, or are you going to pick and choose and let us know which ones that we have to submit?
Yeah, I will pick and choose.
Okay.
Yeah, and give you what you need to. So you just wait for the final exam assignment to appear on your board. That's it.
Okay.
All right?
That's a whole lot of questions.
All right, we're good now then.
All right. So go ahead with this problem. Solve this. This may be in your final exam. So you can do it in Excel now?
Yeah.
Done.
What is that? I would do the MRR, but I don't have it.
Oh, okay. This. Okay. Yeah, okay. So I think it's better to use it.
Right, but
There are two buttons. Use the 10%.
you're right.
Yeah, use the 10% for both lending and.
Yeah, if you,
Yeah, you're right.
So you use MIR,
Yeah.
SIR.
MIR for the first one with the assumption that it's 10%.
I think as long as I have like the answers. Just use like the solution also there. Figure it out.
Section, we like, yo, man, how you come along with this? The capitalism of our example, like, it's $50.
Oh.
Whatever you spend, they return.
Yeah. It gives you
question. Say for example, discounted cash. Now this is happening in the first step. But suppose this is happening in the second. So the formula that we use here is 1 plus. So is it 1 plus or is it appear that there is a negative?
It should be, this is not the one, this is the year before it comes. So
Right.
whatever year before it comes.
Okay.
This may be 1, 2.
So this time we had it was happening third and fourth year. If I apply this for the statement marks. The correct answer is I use the first and second these two values. But if I use if it's happening in the fourth year, if I use 4 plus, then I can this is happening in the fifth year.
Yeah, so it will be year before it comes.
So that's 5
Yes,
plus.
that's correct.
But let me do this. This might give me the same answer if I use 1 plus. I was trying to do something and I look at what use the same term as 1 plus it gives me 5.74. It's just that these two values.
That may be just a coincidence. Can you try it here?
Let me try. That's not about the first one.
That may just be a coincidence. Sometimes the numbers. All right, well done. So where's the attendance sheet? Has everybody signed on this? Yeah.
I don't know. One time.
Done with this problem? Okay, if you're done, then you can go. But if you're done, you'll have to finish this and then go.